the US auto market is sitting on a trillion-dollar time bomb. Right now, Americans owe more money on their cars than at any point in history. Over $1 trillion in auto loans is floating through the system, and cracks are already beginning to show. Just think about that number for a moment. $1 trillion. That is larger than the entire GDP of most countries. It's bigger than the student loan crisis. It's even higher than the total US credit card debt just a few years ago. And unlike credit cards, cars are not investments. They are depreciating assets. The moment you drive one off the lot, it loses value. But the debt tied to that car? That doesn't go away. In recent years, car prices have skyrocketed. New vehicles are more expensive than ever, and used cars, once considered the cheaper option, saw their prices climb to record highs during the pandemic. As buyers scrambled to secure transportation, many had no choice but to finance. Auto loan balances grew larger, monthly payments hit record levels, and interest rates kept climbing higher. For many households, buying a car became the second-largest financial burden, right after their mortgage. Now, combine all of that with aggressive lending. Banks and lenders eager to profit pushed out loans to millions of Americans, often without properly checking whether they could truly afford them. Buyers were convinced that stretching payments over 72, 84, or even 96 months was normal. Some were told, "Don't worry, you can refinance later." But now, with interest rates soaring, refinancing is impossible. And those long loans? They are becoming financial traps. The result is a fragile system, built on debt, high prices, and overconfidence. And just like a house of cards, it only takes one small shake to send the entire structure crashing down. That shake is already here. Delinquencies are climbing, defaults are rising, and repossession lots are filling up at alarming speed. This isn't just another cycle in the car market. This is a full-blown crisis waiting to explode. A trillion-dollar loan bubble is sitting right in front of us. And when it bursts, it won't just destroy car values. It could send shockwaves through the entire US economy. To understand why this trillion-dollar crisis exists, we have to look back at how the car market transformed over the past several years. For decades, buying a car was simple. Prices were fairly stable, interest rates were low, and loans were usually 3 to 5 years long. But that world is gone. Today, the car market looks nothing like it did even a decade ago. It all started with a massive surge in car prices. Between 2020 and 2022, the average cost of a new vehicle in the US jumped more than 30%. Supply chain shortages, chip shortages, and factory shutdowns created chaos. Dealers marked up cars thousands of dollars above sticker price, and desperate buyers lined up anyway. Used cars, once a smart way to save money, became just as expensive. Some models even sold for more used than new. At the same time, interest rates began to rise. What used to be a 3% or 4% auto loan quickly became 6%, 7%, even 10%. That meant the monthly payment on the same car suddenly jumped by hundreds of dollars. But instead of walking away, buyers stretched their loans longer. First it was 72 months, then 84, and now even 96-month car loans are becoming common. People are literally committing to 8 years of payments just to drive off the lot. Banks and lenders encouraged this behavior. For them, it didn't matter if the loan was risky. As long as the paperwork was signed, they could sell the loan, package it up, and pass the risk on to someone else. This is the exact same strategy that fueled the housing bubble in 2008. Back then, it was mortgages. Today, it's auto loans. The result is that millions of Americans are trapped in what's called negative equity. That means they owe more on their car than it's actually worth. Drive the car for 6 months, and suddenly you're thousands of dollars underwater. Try to trade it in, and you'll discover that the dealer offers far less than your remaining loan balance. This negative equity isn't just a financial annoyance. It's the fuel feeding the fire of the coming collapse. Because when borrowers realize they're paying for something that will never catch up in value, many will simply stop paying at all. And that's exactly what's starting to happen right now. The warning signs are no longer hidden. They're everywhere if you know where to look. Right now, auto loan delinquencies, the number of people falling behind on their payments, are at the highest level in nearly 20 years. Subprime borrowers, those with weaker credit scores, are getting hit the hardest. In fact, more than 7% of subprime auto loans are already 60 days past due. That might sound small, but in a trillion-dollar market, that number represents millions of people who simply cannot afford to keep paying for their cars. Repossession companies are busier than ever. Tow trucks are pulling cars out of driveways, shopping mall parking lots, and even workplaces. In some states, repossessions are up more than 20% compared to last year. And remember, every repossessed car doesn't just hurt the borrower, it adds another vehicle back into the used market. The more repossessions rise, the faster used car prices fall. Dealers are already feeling the pressure. Their lots are filling with unsold cars. Inventory levels, which were once at historic lows, are beginning to climb back. But instead of being good news, it's a dangerous sign. High inventory plus falling demand equals collapsing prices. Cars that sold for record highs just months ago are now sitting unsold, with discounts piling up. This is a vicious cycle. As prices fall, the gap between what cars are worth and what people still owe on their loans gets bigger. That negative equity problem grows worse every single month. The deeper people fall into debt, the more likely they are to walk away entirely. And when they do, the repossession cycle accelerates even faster. It's not just individuals being hurt. Banks and lenders are starting to take losses. Auto loan-backed securities, the financial products built from these loans, are flashing warning signals. Investors who once thought car debt was safe are beginning to panic. And when investors panic, liquidity dries up. That means fewer loans being issued, tougher approval standards, and an even sharper slowdown in the car market. The cracks in the system are no longer theoretical. They are visible, measurable, and growing larger every single day. What we're watching is the early stage of a meltdown, one that is spreading faster than most people realize. For everyday drivers, this crisis is more than just numbers on a chart. It's hitting people directly in their wallets, and the impact is brutal. Right now, millions of Americans are stuck in negative equity. They owe thousands of dollars more on their car than it's worth on the open market. Imagine buying a truck for $45,000 with a long-term loan. 2 years later, that truck is worth only $30,000, but you still owe $38,000 on the loan. If you try to sell or trade it in, you're forced to roll the remaining balance into another loan, digging the hole even deeper. This is not a rare problem. Reports show that nearly 1 in 5 new car buyers are now underwater on their loans within the first year of ownership. That's a staggering statistic. It means tens of millions of drivers are paying for vehicles that are depreciating faster than they can keep up with. For buyers trying to enter the market today, the risks are even worse. Interest rates are at multi-decade highs, and lenders are tightening their approval standards. Monthly payments for a new car now average over $750, with some loans pushing beyond $1,000 a month. That's not sustainable for the average household. Families are being forced to choose between reliable transportation and financial survival. And for those who already own cars, the collapse of used car values could wipe out what little equity they do have. Vehicles that seemed like strong investments during the pandemic bubble are now losing thousands of dollars in value in just a few months. The so-called COVID premiums on used cars are evaporating, leaving owners trapped in loans that will never balance out. The harsh reality is that the car market is turning into a financial trap for millions of Americans. It's not just the borrowers who are suffering. Dealers, lenders, and automakers are all feeling the pressure. But for the average person who just needs a car to get to work, the consequences are devastating. They are paying more than ever before for assets that are worth less and less every single day. This isn't just inconvenience. It's financial quicksand, pulling families deeper into debt with every payment. The trillion-dollar auto loan crisis is not just a problem for car buyers and owners. It has the potential to shake the entire U.S. economy. Think back to 2008. The housing market collapse started with rising defaults and negative equity, just like what we're seeing now with cars. At first, people thought it was just a small corner of the economy. But the ripple effects spread everywhere. Banks failed. Investors panicked. Jobs disappeared. What began as a housing issue turned into a global financial meltdown. The auto market may not be as large as housing, but it's still massive. Over $1 trillion in debt means millions of loans tied to millions of families. When those loans start going bad, the pain doesn't stop with the borrower. Banks take losses. Investors who bought auto loan-backed securities take losses. Automakers face collapsing demand. Dealerships struggle to survive as car values crash. And when those businesses cut back, workers lose jobs. It's a chain reaction that spreads far beyond the car lot. Already, warning signs are flashing. Analysts are calling auto loans the next subprime bubble. Credit unions are reporting higher delinquency rates than at any point in decades. Repo yards are filling with cars faster than they can move them. And yet, millions of new loans are still being written every month, pushing the bubble even higher. The truth is, this collapse isn't coming. It's already happening. Prices are falling, defaults are rising, and the trillion-dollar debt load is unsustainable. The only question left is how bad the fallout will be. For the average American, the best-case scenario is a painful correction, where used car prices continue to drop, and borrowers are left paying off loans for cars worth half as much as they owe. The worst-case scenario? A full-scale financial meltdown that echoes 2008, triggered not by mortgages, but by auto loans. Either way, the car market meltdown is real, it's happening now, and its impact will be felt far beyond the dealership. The auto industry built this bubble on years of reckless lending and soaring prices. And like every bubble in history, it can only end one way, with a crash.